What's my risk trading the zero DTs over time? We get a lot more questions about zero DTE risk than we do about zero DT profits, believe it or not. Because people are like, well, how much am I really risking? We challenged the research team to come up with...
And it's the right question to ask, by the way.
Okay, I'm not going to disagree with you. We challenged the research team. I don't know, just a study that would take a look and see, hey, if I have a trade that's going against me, is it better for me to ride to the end of the day, do enough of those come around, or is it better for me to take my loss at some number? Like, let's say I sell a strangle or an iron condor or whatever it is, and let's say I sell something for $1. Is it better for me to take my loss at $1.50, $2, $3, $4, $5, or just let it go? What do you think the answer here is, Pat?
Give me the parameters again.
I'll give you the parameters when we get to that page, because I don't. Do you think it's better to manage a trade, or do you think it's virtually impossible to set like a downside stop?
I'm going to say it's virtually impossible to set a P&L stop, is what you mean, right?
Yeah.
I would say it's impossible to set a P&L stop.
So trading options in sufficiently liquid underlying on the day of expiration gives traders access to some of the fastest, most interesting opportunities. So far, short premium positions have performed generally quite well. Many experienced retail traders have been eager to enter the zero DT marketplace. Us, not so much with volatility this low, but I do get the attraction. This accelerated trading environment can also make zero DT trading. So today we're going to focus on downsides and losses a zero DT short premium trader would have experienced over the last year. We used 1 year's worth of data, and we want to see how ugly does this get using zero DTs. What's the downside like? 52 weeks of zero DT data, and we're going to sell strangles, 40 deltas, 30 deltas, and 20 deltas. We're using delta rather than a dollar amount just to be consistent. But here's the stop losses, Tony. 50%, 100%, or 200% of the initial credit, as well as letting the losers go to the close. All the winners, we close at 25% of max profit. If you're closing at 25% of max profit, where do you stop your losses out?
I'm gonna say 100%.
100%.
And I'll tell you why. I think 50% is still inside the expected range for the day, and I think 200%. At that point, you probably have enough. You're almost at max loss. Why go any further? Why close it? That's my guess.
Okay,
and it really is a guess.
That's fair. The downside statistics for zero DTs, we're going to throw a lot of numbers at you, so just bear with us here. At the 40 delta strangle, which is not a strangle that we necessarily do, but surprisingly, the win rate here was quite high, way higher than I thought it was going to be. The net P&L also was quite good for the 40 delta strangle. This is with all your losses included. But as you can see here, when we look across the board, we're going to go for mean loser, median loser, and then C-bar, like kind of what's the overall risk. And when you start to look at these numbers here, I'm not sure that there is this eloquent takeaway. Do you think so?
Yeah, I don't know if there's a clear winner here.
Everything looked like it was more a matter of preference. This was all about preference. Whether you did no stop loss at all, or you did the 100% stop loss like Tony said, the difference, slightly lower win rate on the 100% stop loss, the mean loser was less, but the net amount of money you made was less. The C-bar was less. So, I mean, you definitely take less risk when you stop yourself out earlier, but you make less money. We don't really do a lot of 40 delta strangle, so we're going to go to the next one, which is 30 deltas. This is still a bit of a stretch for us, but what I wanted you to see on this slide is that the win rates pop up into the 80% handle. They're down in the under 70 for the 50% stop loss, but where Tony liked it, he was around 80%. That's not bad. And the numbers across the board,
80% on everything.
The numbers across the board, the net P&L per day was about the same straight across the board. The mean losers on the 100% was a lot less. The median losers was a lot less, and the C-bar was half. So I'm going to say, so far, I'm going to hand this one a little bit to the bat. Okay.
Yeah, but I think it's pretty subjective right now. I mean,
it is. But if I looked at this, that 100% stop loss, listen, when I trade zero DTs, it's really hard to go with no stop loss. And I'm not talking, this is not a hard stop loss. This is a soft stop loss, meaning that you're just holding this in your back pocket. You're just getting out. When you sell something at $1, you're buying it back at $2. This is the delta that I usually sell. As you can see here, the win rates are pretty high. At the 100% stop loss, it's 80%. At the no stop loss, it's almost 90. but the win rate as how much money you make is highest at the 100% stop loss. If you look at the net mean loser, it's significantly less, like 1/4 of what the mean and median losers are. And the C bar is actually less. So this one is a clear-cut winner to me at the 100%. How did you know?
I didn't. I mean, maybe it's a couple of years of trading experience and listening to our customers and emails and doing it ourselves. So, I mean, I think you learn by doing, and that seemed to be the sweet spot for me.
Yeah, I mean, you're not that good. I've known you a long time. And for you to be, you had a 25% chance and you got it. Because I think that 100% stop loss gave you the best win percentage for the dollars that you won with the least amount of risk that you took. So the past year has been a profitable time to short 0DT premium at the market open as long as the winners were managed aggressively. But in order to see these net profits, traders did have to take an occasional and painful loss. Lenient stop losses reduce downside risk without negatively affecting profits. That's really interesting because usually we are not, we don't, like I was just scalping a few minutes ago and I just took some losses because that's what we do. I don't really set it at 100%, but I set it at some number. And
yeah, but it's a lot easier said than to do it. What you just did just now is very difficult to do.
That's right. To set a strict stop loss, however, meant missing out on trades that would turn around later in the day. So that's why we said they're really soft. But if you decide to try your hand at 0DTs, being attentive, ready to make adjustments is the key. When we looked at it, if you sell something, let's say we sold something at $4, because a lot of the stuff we used to look at was around $4, right?
Yeah, 4.5. Yeah, whatever.
So you're looking at an $8 cover. That's 100%. But if you want to do it at $6, that's fine. If you want to do it at 50 cents, $4.50, that's probably wrong. I'm just saying, but you don't want to do it at $20 either. So you just got to be, the bottom line here is for 0DTs, you have to be aggressive, but you also have to be very cognizant of the statistics. They wrote here, lenient stop losses reduce downside risk without negatively affecting net profits over time.
It's not the place where you can just set it and forget it, which I think a lot of people kind of hang their hat on that. Meaning it's expiration for them, they can just let it go. And I don't think that that's the takeaway on any of the stuff that we look at.